Welcome to the deep dive. We are officially moving past the holiday quiet of that last week of the year.
And stepping right into what our sources are suggesting is well, a major transition point for commercial real estate.
We're looking across that pivotal week, the one that spanned Christmas to the New Year. We're analyzing the data points that signal the end of what some analysts have called peak levels of uncertainty.
That's a key distinction. The environment we're charting for you is really defined by renewed momentum, clearer visibility, and a growing sense of optimism.
So the turbulence from all those rapid rate hikes has largely settled down.
It has. We're seeing macro stabilization, things like monetary easing from the Fed, and even that modest fiscal stimulus coming out of the OBBA.
And for those keeping track, the OBBA is the One Big Beautiful Bill Act. That's the major piece of federal infrastructure spending that's been trickling into the economy.
So you've got this monetary ease meeting a modest fiscal push.
But the real story here, it's not uniformity. It's what the sources are calling a sharp sectoral divergence, a bifurcation across all the asset classes.
Exactly. And while everyone is rightly focused on the future of AI infrastructure and, the data center explosion that comes with it,
Right.
we're drilling down into this surprising and I think far more stable resilience of the retail sector.
Especially when you look at high-growth metros like Dallas-Fort Worth.
That's where the smart money is moving right now.
Okay, let's unpack the fundamentals then. What are the anchor economic numbers that are really setting the stage for 2026?
Well, real GDP growth is projected to land somewhere between 1.7 and 1.9% for the year ahead.
Okay.
But here's the massive caveat. More than half of all GDP growth in the prior year was attributable directly to AI-driven capital investment.
Wow, more than half.
More than half. So the economy is growing, yes, but it's deeply reliant on this single technological sector. This creates specific opportunities, but also, specific risks for CRE markets that aren't tied into that tech race.
That concentration of growth is certainly something to monitor. Now, for everyone focused on financing deals, the Federal Reserve's stance is, of course, paramount.
It is.
After the cuts we saw, the benchmark interest rate is now sitting in the 3.5 to 3.75% range.
And this is where we see the first little flicker of a market disconnect. Financial markets are pricing in at least 2 more quarter-point rate cuts for 2026.
Okay.
However, if you look at the Fed's internal forecast, what's commonly called the dot plot, it signals much greater hesitation among policymakers.
So they're not on the same page.
Not at all. They're hinting we may see only a single cut, maximum.
So the market expects 2, but the Fed is hinting at 1. That's a crucial difference for pricing risk. Why is the Fed signaling so much caution, even with inflation having cooled off?
They're keeping a sharp eye on 2 things. First, persistent core inflation, particularly in the services sector. And second, the possibility of renewed tariff-induced price shocks that could impact global supply chains.
So the takeaway is we have stabilization, but the days of ultra-low rates are just not coming back.
Not on the table. Borrowing costs around 6% are pretty much the new baseline for a lot of these leveraged transactions.
And yet, even this new certainty, even at these higher rates, it's finally cracked the ice jam. We're seeing institutional money finally moving off the sidelines.
Absolutely. The certainty, not necessarily the affordability, has had an immediate effect. We saw a robust 17% increase in institutional sales activity through the close of 2025.
Which suggests that the difficult price discovery phase is largely over.
It is.
Can we quickly clarify what that means for our listeners? Is this basically saying buyers and sellers have finally stopped arguing about what assets are actually worth?
That's the simplest way to put it, yes. For 2 years, you had sellers holding on to 2021 valuations and buyers demanding massive discounts because of 6% interest rates.
A stalemate.
A total stalemate. That's broken now. Transactions are clearing because buyers and sellers are finally aligned on today's true risk-adjusted value. And this unlocked capital is now flowing toward defensive positioning and value creation.
Okay, so if capital is moving defensively and it's prioritizing stabilized income streams to hedge against volatility, that brings us directly to the retail sector.
It does.
Which is exhibiting this extreme bifurcation we keep mentioning.
Indeed. It's really a story of opposites. The neighborhood center is, it's the real estate success story of the last few years. U.S. neighborhood center vacancy rates stood at just 5.2% at the end of 2025.
5.2%. That's the lowest level in over a decade.
In over a decade.
That is incredible tightness for a sector that everyone thought was dying 10 years ago.
Yeah.
What's fueling this strip mall renaissance?
A couple of factors. First, supply is just minimal. There hasn't been a lot of new construction to dilute the market. And second, the fundamental shift in work patterns. More hybrid, more work-from-home schedules that keeps people closer to home. They need convenient grocery stores, dry cleaners, quick service restaurants near where they live.
But the other side of that bifurcation is brutal. The sources reported some intense structural weakness in legacy assets, specifically that Saks Fifth Avenue was weighing a Chapter 11 filing.
After missing a serious $100 million interest payment. That is a stark signal. The high-end discretionary retail that relies on foot traffic in these, aging anchor department stores is just fundamentally struggling.
And we're seeing that same weakness in the challenge of repurposing all that excess space. That massive $947 million deal for 117 JCPenney properties collapsed.
After the buyer missed a deadline, that's nearly $1 billion of real estate that needs a buyer willing to take on the massive headache of conversion.
So what happens to it?
Well, Comper Property Trust is scrambling to find new buyers for these huge, often obsolete, big box spaces. We're seeing that space increasingly repurposed, often for industrial warehousing or maybe specialized medical use, but it requires significant capital and vision. It's a game of real estate Darwinism, really.
So back on the success side, what's making the consumer keep spending and fueling these neighborhood centers even when consumer sentiment readings have been so stubbornly low?
It's not irrational spending, it's targeted spending. Retail sales grew a solid 0.5% in October-November, which defied the sentiment index.
Okay.
The resilience is being attributed to, solid holiday spending, but also what analysts call persistent deal-seeking behavior. Shoppers are highly price-sensitive. They're focusing on essentials.
And that defensive mindset is exactly why the grocery-anchored retail model is so compelling for investors right now.
Absolutely. That model is highly defensive. It insulates landlords from broader economic swings. By the end of 2024, the spending gap between dining out and groceries reached $21 billion as consumers prioritized at-home consumption.
$21 billion.
It's a huge number. If you want a secure income stream in this kind of economy, grocery-anchored retail is one of the most reliable hedges you can find.
Beyond groceries, we are also seeing urban retail adapt dramatically. It's moving away from just shopping toward being a destination.
The $550 million renovation of One Times Square is a perfect example of that. It's shifting to an experience-driven value driver.
And operators are adjusting their physical footprint, too.
They have to counter rising costs, especially labor and rent. Look at a chain like the Japanese concept initially. They're targeting just 300-square-foot kiosks for their expansion. It shows that value in retail space is now measured in efficiency, not just square footage.
Okay, let's unpack all this and bring it home to a specific geography. DFW is the market where all these positive retail trends, low vacancy, high absorption, strong institutional appetite, they're all amplified.
It is, year after year. DFW was again named a top U.S. real estate market for overall prospects for 2026 by ULI and PwC. And this isn't a coincidence. It's rooted in structural advantages.
Relentless population growth, massive corporate relocations.
And job diversity. That structural strength underpins sustained, reliable growth that other markets just envy.
And we're seeing immediate, tangible evidence of institutional confidence. The shops at Legacy North and Plano recently sold for $78 million.
A staggering number. And that's a powerful demonstration of the deep institutional appetite and liquidity that exists specifically for high-quality suburban retail centers in North Texas.
And the pipeline isn't slowing down.
Not at all. Stillwater Capital and Woodhouse just broke ground on a $750 million transit-oriented mixed-use project in Plano. That reflects the continued, vigorous demand for the suburban live-work-play model.
Now, here's where it gets really interesting for me. The sheer competitive energy in Texas retail is driving unprecedented development. Our sources dubbed 2025 another year of the grocer in Texas.
And DFW retail occupancy is expected to hit a record high of approximately 95.6%.
Yeah.
That record occupancy is a direct result of competitive pressure. HEB's rapid market entry into North Texas has forced a massive defensive response from the incumbents. And that benefits real estate investors.
The clearest example being Walmart breaking ground on 3 massive new supercenters simultaneously in Frisco, Melissa, and Salina.
Their first new DFW supercenter since 2013.
That is a profound signal of confidence in the long-term suburban growth of North Texas.
It absolutely is. This move isn't just standard expansion, it's a direct response to HEB. And for developers and owners of surrounding retail pads, this competition between the major anchors, it acts as a mega anchor.
Pulling in huge consumer traffic.
Huge traffic. And it spurs significant, high-quality retail development all around them, reinforcing DFW's position as an undeniable retail growth engine. That local dynamic is a unique source of value.
So zooming out to connect DFW's growth back to the overall CRE landscape, we have to talk about industrial and data centers. They are the primary beneficiaries of this global AI infrastructure race.
The scale of investment is just staggering. We saw SoftBank acquire Digital Bridge for $4 billion, and Alphabet acquired Intersect for $4.75 billion, focused squarely on securing server-ready power capacity.
Power capacity, that is the critical defining bottleneck for this entire sector, isn't it?
It is. Data center development is facing long delays, 4 years or more, because of power infrastructure constraints. Power availability has become the scarcity factor that overrides everything else.
Even standard NMBWA concerns.
That's right. Developers are simply chasing kilowatts now, not just acreage. And this national industrial strength has a direct connection to DFW's periphery. The Texas Instruments semiconductor facility in Sherman is expected to catalyze a massive tech manufacturing ecosystem right in DFW's backyard.
Let's shift gears to the office market. Are we seeing any relief there, or is the pain set to continue?
The office market is experiencing a profound flight to quality. What that really means is there's this widening, yawning gulf between brand new Class A trophy buildings and the obsolete Class B and C assets.
Okay.
Nationally, Class A vacancy is stabilizing below 18%, suggesting those premium assets are holding on to tenants. But the older buildings are facing a major reset year in 2026.
So the crisis is really limited to the bottom two-thirds of the market. And in Dallas, we're seeing a specific trend helping to clear that older inventory: owner-user deals.
Exactly. We are seeing a noticeable trend where local companies are taking advantage of lower valuations to just purchase their own headquarters rather than leasing. This takes inventory off the leasing market and lets them gain a foothold at a good price.
And we also see adaptive reuse providing a path forward for the truly obsolete assets.
Absolutely. A record $867 million loan was just financed for the conversion of 111 Wall Street in New York from office to residential. That's a crucial sign of lender confidence in this strategy, and it's a trend that DFW, with its deep stock of older office parks, will likely lean into heavily.
Before we wrap up, let's quickly touch on multifamily. That sector saw a huge supply wave, particularly across Texas.
That Texas supply absolutely peaked in 2025, which, naturally slowed rent growth. However, the good news is that the construction pipeline has since contracted by over 70%.
So a correction is coming.
A correction is coming. Continued strong population absorption in DFW means experts predict a sharp rent recovery beginning in late 2026, putting that sector back on a path toward healthy stabilization.
So after analyzing this pivotal transition week, what does this all mean for you, the listener? The key takeaway seems to be that the CRE market has successfully navigated the transition out of peak volatility.
I think that's right.
The focus for 2026, regardless of the asset class, is now squarely on the fundamentals: superior location, sustained demand, and operational excellence.
Absolutely. And when we look at DFW, the region's structural advantages, that population growth, job diversity, corporate relocations, they continue to provide compelling defensive opportunities. The strength we're seeing in grocery-anchored and suburban retail makes it an exceptionally strong, reliable bet for capital that's seeking stability.
And as we move into this new phase, the very definition of a valuable asset is fundamentally changing. It's not just about the physical space and the cap rate anymore. Our sources indicate that a massive 72% of corporate real estate leaders cite cost and budget efficiency as their top priority for 2026.
This efficiency mandate is what's driving the next phase of value creation. The future of superior asset valuation will be driven by integrating AI into tenant operations. We're talking about using AI for things like predictive maintenance, fixing an HVAC unit before it fails.
Or lead to lease automation in retail centers.
Exactly. That technological efficiency imperative, turning existing assets into truly smart buildings to lower operating expenses and drive a quantifiable ROI on things like ESG upgrades, that's what will separate the top-tier assets from the rest.
So here is a final provocative thought for you to consider. If operational cost control is the new priority, How quickly will the market begin to price that technological efficiency, or the lack of it, directly into the acquisition cap rate?
The value of tomorrow's real estate is no longer static. It's defined by its ability to learn and adapt to tenant needs through technology.